Hey everybody, it is Macro 4.2 Loanable Funds. We are learning from home and it's going to be a lot of fun. So, this is AP Macro 4.2 Loanable Funds, and we're going to talk about the loanable funds market. So, we've been talking about different types of investments and where those investments go. And one of the ways that we graphically represent that in AP Econ is the loanable funds market. This, like it sounds, connects customers who want to borrow with suppliers who want to lend money, and banks are the facilitators who handle these transactions. Here is a graphic representation of the loanable funds market. Doesn't look very different from our supply and demand market, but like I've told you, price always goes on the y-axis. In this case, the price is the real interest rate, and the quantity is the quantity of loanable funds. One thing you do want to notice when it comes time to draw these graphs is that you need to title your graph. Often we'll be talking about the money market, which is a topic we'll cover a little further in the course. And so you want to make sure that it's clear that this is the loanable funds market. You can do that either by titling the graph here or by writing quantity of loanable funds here. Either is acceptable, but why not be safe and do both? In addition, you need to be clear which interest rate we're discussing. This is the real interest rate. As you'll remember, that is the interest rate when it's adjusted for inflation. So make sure that you label it real interest rate. That's often why the R is used on the y-axis to show that it's the real interest rate adjusted for inflation. Quantity, of course, is quantity, so that's nice and easy. All right, who participates in the loanable funds market? For starters, you and I often participate in the loanable funds market. If you swipe a credit card, you are actually accessing loanable funds that you may pay off on time and not feel an interest penalty, but they're hoping that you won't and you'll pay an interest rate of 18 to 22%. At those rates, it's worth taking the risk that you pay it back and don't make the bank any money. Who participates in the loanable funds market? Demanders, businesses, individuals, or governments who want to borrow money at interest, participate in the loanable funds market. So, for a business, if you want to increase your capital stock; for an individual, if you want to buy a house or a car, or if you swipe that credit card and take the risk of paying interest if you don't pay your bill in full; or finally, governments who are putting in place projects and need to borrow funds in order to spend that money. Suppliers of loanable funds are businesses who want to save some money. Maybe they've got a big capital project coming up and they want to save the money until it's all ready. Individuals for the same sort of reasons, money you put in your savings account. Or governments who, again, maybe are saving for a big road repaving project or have a bond issuance. That would be an example of people who participate in the loanable funds market and the supply side. Demand shifters. One of the things that really changes demand is how much consumers are willing to borrow. If consumers are borrowing more, maybe they move away from using their debit card to using their credit card. Maybe they are more likely to buy a house or a car and feel better about the markets. They're going to borrow more. As you can see, when we recovered from the 2009 recession, loan originations were very low, but they began to increase over time. As you might guess, I'm recording this during the time of the coronavirus pandemic. Those loan origination rates, in my opinion, are probably going to drop. People are a little more uncomfortable buying things like cars and houses right now with the uncertainty in the economy. So I would guess that loanable funds demand is going to go down as a result. Even though buying your groceries and swiping that credit card can be participating in the loanable funds market. Businesses, of course, borrow, like the business here that's going to send space-based internet satellites. That's an extremely expensive proposition, so they can either put out a stock issuance and lose ownership of their company to shareholders who are interested in this business, or they can borrow by putting out a bond issuance or going directly to a bank. Government borrowing also changes demand, and we'll talk about that in depth when we talk about crowding out. Supply shifters, change in private savings behavior. The money you put in your savings account changes the amount of loanable funds in the market. The bank can loan out a portion of your savings to people who are willing to borrow. Changes in public saving behavior. So, for example, if the government is saving, again, we think about the federal government is always running a deficit, but state and local governments often do have rainy day funds in savings
in the United
that
States.
would provide vulnerable funds to the
Individual
rest of
and
the market.
business investors will also buy bonds in countries that are more safe, like the United States.
So foreign investment monies move to where either interest rates are higher, looking for a profit, or situations are more stable politically. And government borrowing, which is crowding out. Notice I mentioned crowding out on both the demand and the supply side. So let's talk about what it means. Crowding out is when the government borrows money to finance projects. The government is not sensitive to interest rates. So, for example, during this coronavirus pandemic, the House has just passed a bill providing relief aid in lots of ways. Things like extending unemployment benefits, increasing sick leave, paying for testing and health care. That's money that the government doesn't have on hand, so it will have to borrow. It will borrow by selling bonds to people who are interested in buying them. And it doesn't care if the interest rates on those bonds go up. So it sort of goes to the front of the line because banks, of course, want higher interest rates, and they're going to see governments as much more stable than the average investor, business, things like that. So, because the money that we use is backed by our government, they're going to trust the government more than a business or individual borrower. So they get to sort of break in front of the line. The government is going to get their money even at that higher rate, which means that there's not going to be quite as much available for the remainder of consumers. So you could look at this as an increase in demand. Now this line has gotten bigger and we see our guy walking there, but the other piece about him is that he's going to be a much bigger borrower than any of those individual customers, businesses, or households that are also in line. Another way to look at it is that the government, because it's such a trustworthy borrower, it's going to suck up all those funds and keep anyone else from getting them. So the government will get all the funds at once, but there'll be sort of crumbs left over for everyone else. So the government gets in line, takes the funds, and leaves very little for everyone else. I'm really proud of the way I wrote this, so hopefully you're enjoying it too. Here's what the graphs look like. So we got to ruin all that fun with graphs. So here's our loanable funds market. And what you'll notice is one way to graph it out is that the government is a demander and they increase demand. Just like if you and I started getting more loans, we would increase demand. The effect on the real interest rate is that it goes up. The quantity of loanable funds increases because people are more willing to loan to a government than an individual or a business. Another way to look at this crowding out is that the government sucks away the supply for the remainders of people in line. So the government takes away loanable funds, and what's left for businesses and households is artificially high compared to a rate that the government, a very trustworthy customer, could get. So that raises rates, not just what gets raised on the government, but even more for borrowers who are less trustworthy with lower credit scores or lower credit worthiness. So this is the way with the supply shift that I like to graph crowding out. However, on exams, if crowding out is given, both answers are acceptable. Often they will say explain. So that's where you're going to get the right answer, additional right answer points. You need to explain that the government is a large actor that shifts demand in the market, or the government sucks up the supply of available funds, decreasing supply for businesses and consumers. I again tend to graph the graph on the right, but either graph is acceptable. Notice in both cases, interest rates go up. So the quantity of funds does go up in the market, but the quantity of funds available to businesses and consumers goes down. Hope you're enjoying that out there, my folks who like nice, clean, one-way answers. All right, so when we talk about crowding out, there's a real theory that crowding out means that businesses are not going to be able to invest in capital. That means, of course, adding new lines, but it also may mean replacing capital that is worn out or needs updating for a new economy. This could, in the long run, potentially lead to a decrease in long run aggregate supply. So in the shorter term, it would decrease aggregate supply, But the argument with crowding out is that yes, we can spend government monies to fix the economy, but that does come at a cost. And that cost is our future growth because of lack of investment in capital stock, because the government is sucking up all the available funds that would allow for that investment. So again, that's going to shift the long run aggregate supply to the left and could potentially shift the PPC inward. All right, so let's practice a little bit with these documents and this new information that we have. Here I have 7 scenarios. I want you to pause the video and graph out what you think will happen to the loanable funds market. I put a couple of questions for the future that we'll discuss. Make a guess at what's going to happen. Number 7, I feel pretty confident that you can do. Number 6 may be a little tricky since we haven't talked about the Federal Reserve yet, but you can't hurt yourself to make a guess. One thing I would do though is practice drawing these graphs. We do it over and over in class. The more practice you have, the better off you are. Here's what I'm going to be checking to see if a graph is acceptable. Do you have it labeled as the loanable funds market in some way? Do you have your price, the y-axis, labeled as the real interest rate? Do you have your quantity labeled as the quantity of loanable funds? Or, of course, do you have that loanable funds graph title? So when you draw those graphs, get in the habit of labeling it the loanable funds market and putting that real interest rate and using the letter R for your y-axis values. Pause the video and then let's go over the answers. So for number 1, if citizens begin to use debit cards instead of if citizens begin to use credit cards instead of debit cards, this is the graph that you'll see. So you'll see a situation here where the demand for loanable funds will increase because people are borrowing essentially when they swipe those credit cards. That's going to drive interest rates up. And as interest rates go up, the quantity of loanable funds will increase and you move along the supply curve. If we have the spending bill, this is our crowding out. So either of these answers are acceptable. Again, if I asked to explain and you drew the demand curve, you would need to say this is because the government is a demander in the market. And as a large demander, they're going to shift that demand out if the government is borrowing a lot of money and raise interest rates, and the quantity of funds available will increase. However, if you are saying that supply decreases, you need to say because the government will get all the loans that they want, the loans that remain available that aren't crowded out will be at a higher interest rate and there will be a lesser quantity available to businesses and consumers. Here, if a recession slows lending, that is because consumers and businesses are unwilling to borrow for capital improvements during a recession, and that's going to lead to a decrease in demand. That drop in interest rate, of course, will make the banks less willing to loan out money. If businesses finance capital projects, that's going to increase demand. So this will be when times are good, when we're experiencing an inflationary cycle. Businesses are more likely to finance capital projects. They feel like they're going to see a bigger real return, and that's going to increase demand for those businesses. If consumers begin to save more, you'll see an increase in supply in the loanable funds market. If consumers or businesses channel more of their money to banks, that money is there available to be loaned out, which means interest rates will drop as the quantity of funds available increases. Now for our future questions. If the government raises the reserve ratio is the amount of money banks must keep on hand and cannot lend out to consumers or businesses. So that would decrease the supply of available funds, leading to an increase in the interest rate. This is one I feel confident you could get, so hopefully you thought through it correctly. If rates are higher in the US than in Canada, I'm going to put my money in US banks. There's nothing saying that I can't. So the supply of funds will increase in the United States. Interest rates will therefore drop and the quantity of funds available will increase. Hope all of this helped you, and